Don't forget to like this video and subscribe if you want more deep dives into today's top investment opportunities. Now let's get into a complete investment analysis of Pfizer, ticker symbol PFE. Pfizer, one of the largest pharmaceutical companies in the world, has seen a notable shift in its financial and strategic positioning in 2025. After a difficult 2023 and 2024, when declining COVID-related revenues and high acquisition costs put pressure on its margins and stock price, the company has started to rebound in the first half of this year. In the second quarter of 2025, Pfizer reported revenues of approximately $14.65 billion, which represented a strong 10% year-over-year increase, beating market expectations. This uptick was largely driven by solid performance across its core therapeutic areas, including oncology, immunology, and rare diseases. Key revenue drivers included Eliquis, Vyndaqel, Ibrance, and the cancer treatment Padcev, as well as modest contributions from its antiviral Paxlovid. Although COVID-related sales are declining, they still add meaningful cash flow. Adjusted earnings per share for the second quarter came in at 78 cents, well ahead of the 58 cents expected by analysts. Reported net income under generally accepted accounting principles was approximately $2.91 billion, or 51 cents per share, which is a significant improvement from the same quarter a year ago, where net income was nearly zero. A major factor in this rebound is the company's aggressive cost-cutting program. Pfizer is on track to realize over $4.5 billion in cost savings by the end of 2025, part of a broader plan to achieve between $7.2 and $7.7 billion in savings by 2027. These cost improvements are being used to protect margins, fund research and development, and support future product launches. On the cash flow front, Pfizer's financial position remains stable. The company is generating consistent free cash flow, even while funding recent acquisitions such as the $43 billion buyout of Seagen. While debt levels have increased slightly in recent years due to these acquisitions, the company is gradually paying it down, and interest expenses remain manageable. Pfizer continues to prioritize shareholder returns through a reliable dividend, which currently yields above 5%, making it one of the more attractive dividend-paying stocks in the large-cap healthcare sector. From a technical analysis perspective, Pfizer's stock is still trading near multi-year lows, hovering around the mid-$20 range. Although the price has recently bounced off its bottom, it has yet to break out of a long-term downward trend. The relative strength index has occasionally dipped into oversold territory, suggesting that the stock may be undervalued in the short term. However, the absence of strong volume or buying momentum suggests that investor sentiment remains cautious. Unless there is a major pipeline breakthrough or stronger quarterly growth, the stock may continue to trade sideways in the near term. Looking at Pfizer through a SWOT lens, the company's strengths are clear. It boasts one of the most globally recognized pharmaceutical brands, a diversified drug portfolio, and a robust research and development pipeline with over 90 products in development, spanning vaccines, oncology, immunology, and rare diseases. Its partnership strategy, including licensing deals like the one with China-based 3S Bio, and its investment in artificial intelligence-driven drug discovery platforms, is positioning it well for long-term innovation. Weaknesses, however, include its ongoing dependence on a handful of mature drugs, most notably Eliquis and Ibrance, both of which face looming patent cliffs in the coming years. Additionally, while recent acquisitions such as Seagen and Biohaven have expanded its oncology pipeline, they have also increased financial leverage and operational risk. Opportunities lie in its expanded oncology footprint, potential new vaccine launches, and synergies from its recent acquisitions. The company is also aggressively pursuing artificial intelligence in drug discovery, which could significantly reduce time to market and lower research and development costs over the next decade. However, the company faces several threats. These include increasing regulatory scrutiny around drug pricing, especially in the United States and European markets, competitive pressure from generics and biosimilars, and global macroeconomic instability that could impact healthcare spending or pharmaceutical supply chains. In summary, Pfizer has shown that it is capable of executing on cost reductions and stabilizing revenues despite a decline in COVID-related sales. The company is in a transitional phase, moving from a pandemic-era revenue spike back to its core therapeutic growth model. While its long-term pipeline holds promise, particularly in oncology and immunology, near-term headwinds like patent expirations and a lack of strong technical momentum limit the upside potential for now. Given all factors, improving fundamentals, a secure dividend, cautious technicals, and both risks and potential in its pipeline, a hold rating appears most appropriate at this time. Investors already holding Pfizer for income may continue to benefit from its dividend and future recovery, while new investors may want to wait for either a technical breakout or greater visibility on pipeline execution before initiating a position. Thanks for watching. If you found this breakdown helpful, hit that like button and subscribe to the channel for more weekly stock analysis. Let us know in the comments what stock you want us to cover next.